It's been nearly a month since Trump announced the 90-day tariff break, triggering a historic rally, with the S&P 500 and Nasdaq soaring over 9%. Since then, the Fear and Greed Index has climbed off its extreme low of 4, but what happens when the break ends? Last time tariffs hit, the market dropped over 5% 2 days in a row. Could we see another sell-off or an even bigger rally? On April 9th, 2025, President Trump announced a 10% tariff on all countries that export goods to the US. He made this decision because he believed the US was being treated unfairly in trade deals, and he wanted to fix the trade imbalance by making four region countries pay more for doing business with the US. And the market wasn't happy about that, as it caused fear and uncertainty, which led to a 2 day 5% drop. But this didn't last long, as he introduced a 90-day tariff break for all countries except China, which is still in a high tariff standoff with the US at the moment. But when this tariff break comes to an end, what should we expect? Should the market go up or down? Well, it really depends on how the other countries decide to respond, because these tariffs could escalate quickly, just like we already saw with China. Right now, some of those tariffs have reached up to 245%. That includes a 20% general tariff, plus aggressive sector specific tariffs like 100% on electric vehicles, 50% on solar panels, and 25% on lithium ion EV batteries. We probably won't see that same situation with Europe, but again, it all comes down to whether or not they manage to reach a deal with the US before the 90-day tariff break expires. If no agreement is made, Europe may feel backed into a corner and respond with their own set of tariffs, potentially mirroring what the US has imposed. That kind of response from Europe could be devastating. Why? Because it would drive up the cost of goods across the board, squeeze company profit margins, damage export activity, and force businesses into difficult decisions, either raise prices for consumers or absorb the losses themselves. Neither option is good, and both can weaken economic performance. Over time, this pressure could lower company profits, weaken investor confidence, and slow down the economy. If tensions keep growing between major countries, it could lead to a full trade war, one that could stop global growth and cause even more ups and downs in the markets. The second scenario that could happen is if Europe and other countries reach a deal with the US before the 90-day tariff break ends. If that happens, the market would likely calm down and the fear and uncertainty would decrease. This would likely cause the stock market to rise significantly, as investors would feel more confident. However, as of now, with almost 30 days past and no deal in sight, things could get tricky. The longer the negotiation drag on, the more uncertain the situation becomes. But at the same time, as we get closer to the end of the 90-day tariff break, the market will likely start to adjust to the reality that a deal may not happen. If that's the case and a deal does eventually come through, the market could respond with a big surge, as the surprise of a deal will create a lot of optimism among investors. The last scenario is if Trump decides to extend the tariff break for more days. This could be very likely if some but not all countries reach a deal with the US. If that happens, those countries might need more time to finalize their agreements, which would push Trump to extend the tariff break. I think this scenario is more likely because it's probably that not all countries will manage to make a deal with Trump in the next 2 months, so extending the tariff break would give them more time to negotiate. If this happens, it could lead to the market fluctuating up and down depending on the news coming out about whether or not progress is being made on those deals. Each piece of news could move the market in different directions, making things more uncertain in the short term. So we know the possible scenarios that could happen, but what sector would be affected if these tariffs take into place? Well, first of all import heavy industries would get hit. This means automotive, technology, retail, and even energy. Companies that build cars, cell phones, import clothes, or move goods around would all face higher costs. For example, car companies rely a lot of foreign parts, so a tariff would make building cars more expensive, which could mean higher prices for consumers or smaller profits for the companies. Tech companies, especially ones that make hardware like smartphones and computers, would also take a big hit because many parts are made overseas. Retailers who sell products made outside the US would have a tough choice, either raise prices or make less money. Neither is good. Even the energy sector could feel it because things like solar panels and batteries, which are imported heavily, would cost a lot more under higher tariffs. And if these sectors start to struggle, it could drag down the whole stock market with them, since these industries make up a huge part of the economy. But it's not all bad news. Some sectors can actually benefit from the new tariffs. For example, American steel, aluminum, and certain manufacturing companies might see an increase in demand as imported goods become more expensive. When imports are priced higher, local products become more attractive to buyers, and companies that sell made in USA goods could gain market share. This shift could give a short term boost to smaller companies, particularly small cap stocks as well as industrial stocks. These companies might benefit from increased sales and higher demand for their products, which could lead to positive stock price movements in the short term. Now, what does all this mean for your portfolio if you're an investor? Well, it means your portfolio could become a lot more volatile. That's because in the short term, news has a big effect on the stock market, just like we saw recently with Trump's tariff announcement. Stock prices can swing up or down quickly based on headlines, even if the long term outlook for your investments hasn't changed. When the market reacts like this, there are two smart things you can do to protect and grow your money. The first option is to stay calm and hold on to your long term investing plan. If you believe in the companies you're investing in, don't let short term news scare you out of your positions. Sometimes the best move is simply to wait and let the market settle. The second option, and the one I personally like the most, is to see this kind of market shakeup not as something to fear, but as a real opportunity. In the investing world, these moments of uncertainty can often open the door to some of the best deals. That's where the idea of buying the dips comes in. When stock prices fall because of short term fear or negative news, but the company themselves are still strong and solid, it can create a chance to buy those same companies at a much cheaper price. If the business fundamentals haven't changed, meaning the company is still profitable, growing, and well managed, then the lower stock price just means you're getting more value for your money. It's like buying your favorite products on sale, but in this case, it's shares of a good company. You can also take this time to explore new investment opportunities. Maybe there's a stock you've been watching for months, but it always felt too expensive to buy. During a market dip, that same stock could drop to a price that finally fits your budget and investment strategy. That's your chance to grab it while others might be panicking or selling. The key here is to stay calm and think long term. Don't just react to fear, take advantage of it. While others are selling out of emotion, you could be buying quality stocks at a discount. Over time, this strategy can really pay off, especially if the market recovers and those same stocks rise again in value. And to find the best deals fast, you need good data. That's why I recommend EODHD. They give you real time stock prices, historical data, financials, and more, all in one easy to use API. It's simple, affordable, and super helpful if you want an edge when picking stocks. I'll leave a link below if you want to check them out. At the end of the day, no one can predict exactly what will happen when the 90-day tariff break ends. Whether we see a full trade war, a last minute deal, or an extension, the market is likely to stay volatile. As an investor, the best thing you can do is stay focused on your long term plan, not get shaken out of by short term noise, and look for opportunities when great companies go on sale. Times like these can actually be the best moments to build wealth if you stay patient and act smart. Thanks for watching. Now, if you want to learn about things that can actually harm your portfolio, watch this video right here.